What's going on, everybody? Rashad here, credit specialist here at Lakefront Credit. I'm going to give you 7 ways you can totally damage and destroy your credit score. It's so important to remember that maintaining a good credit score is crucial for financial stability and access to favorable interest rates. Deliberately or inadvertently damaging your credit score can have serious long-term financial consequences. Here are some of the worst ways to destroy your credit score. Number 1, late or missed payments. Failing to make your credit card, loan, or utility payments on time can significantly impact your credit score. On-time payments are the biggest factor affecting your credit score, so missing a payment can sting. If you have otherwise spotless credit, a payment that's more than 30 days past due can knock as many as 100 points off your credit score. If your score is already low, it won't hurt it as much, but it still can do damage. Number 2, maxing out credit cards. Maxing out your credit cards increases your credit utilization ratio, or the amount of credit you're using compared with the amount of credit you have available. Credit utilization is among the biggest factors in your credit scores, which helps lenders evaluate your credit risk when deciding whether to loan you money. Most financial experts recommend keeping credit utilization below 30% to maintain a healthy credit score. Number 3, defaulting on loans. Defaulting on a loan, such as a mortgage or student loan, can severely damage your credit score. In most cases, it also signals additional credit damage and financial challenges to come. Default typically occurs if you go 90 days without making a scheduled debt payment. Depending on the type of loan, defaulting typically triggers a response from the lender that will do additional harm to your credit. Number 4, applying for multiple credit accounts in a short period. Frequent credit applications can make you appear financially unstable. Each application results in a hard inquiry on your credit report, which can lower your score temporarily. One often overlooked risk of applying for a large number of credit cards within a short time frame is the risk to your existing bank relationships. Some banks are sensitive to existing card members submitting a large number of applications for credit or increasing the amount of credit they have too quickly. If a bank determines that you are at risk of a credit default or breakaway fraud, they can quickly shut down all of your accounts. Many banks will even take away any reward points that you have accumulated if they shut down your accounts. Number 5, closing old credit accounts. Closing old credit accounts can impact your credit utilization ratio, which compares your outstanding debt to your available credit. Closing accounts reduce your available credit, potentially increasing your credit utilization and harming your score. Closing a credit card can also affect your score because it can lower the average age of accounts on your credit report, especially if it's an account that's been open for a long time. The age of your accounts is factored into your credit score, with longer payment histories bolstering your credit score. Number 6, settling for less than the full amount owed. An account marked as settled for less than full balance will be a negative mark on your credit report. While it may be a relief in the short term, it can negatively affect your credit worthiness. When you settle, the account will not be removed immediately from your credit report. If you were late on payments, the account will remain on your credit report for 7 years from the original delinquency date. And number 7, co-signing for someone with poor credit. Co-signing a loan for an individual with a low credit score means you're equally responsible for repayment. If they default or miss payments, your credit score can suffer. Also, your debt could increase since the consignee's debt will appear on your credit report. That debt will be added to the amount owed portion of your credit score. Third, it can impact your ability to get a loan for yourself. Taking on any kind of additional debt typically increases your debt to income ratio. This doesn't directly affect your credit score. However, debt to income ratio is a key factor for lenders in evaluating whether to give you credit, and if so, for what terms. Remember, it's important to prioritize responsible financial behavior and maintain a good credit score to enjoy the benefits of favorable interest rates and access to credit when you need it. Thank you so much for watching. Please like, share, and subscribe, and we'll see you on the next video.